Hello, listeners, and welcome to The Credit Compass, the podcast that helps you chart your course through the world of European credit. I'm Gordon Kerr, European macro strategist and host. The Credit Compass aims to be your trusted guide through the complex world of credit markets, capital flows, and economic trends shaping our lives. I am here to help you digest the latest developments in the financial world with clarity, insight, and the right amount of perspective from a credit lens. Today, we're diving into a number of topics dominating discussions in financial and economic circles as headlines fly across our screens. In this episode, we will explore ongoing macro divergence, inflation's gradual retreat, the potential for deregulation in Europe, the evolving unemployment picture amid the rise of AI and slowing European growth, and of course, President Donald Trump. We just can't seem to get away without discussing him. All right, let's get started. After months of central banks walking a tightrope, inflation seems to be coming under control. CPI data is showing inflation stabilizing closer to central bank targets in both the US and Europe. In the long run, we think this holds true as the inflation migration to target will continue. However, it is likely to face some bumps along the way, particularly within the UK. Recent wage inflation numbers suggest a pickup in wage inflation, which will feed through into services inflation numbers. Add this to the minimum wage increases announced by the government in the October budget, and the country is then at risk of struggling to get inflation under control. As a result, we are likely to see rates continue to stay higher in the UK. In Europe, the picture is very different, with growth still a struggle and inflation declining. The ECB has signaled recently that rates are likely to be cut 4 times over the course of the year, taking expectations for policy rates to be at 2% by the end of the year, versus expectations in the UK and the US for rates to only reach 4% by the end of the year. However, within Europe, we note that the inflation picture differs greatly across the various countries, with cuts at risk of increasing this divergence. For credit markets, the story this week is encouraging. Bond spreads have tightened slightly, reflecting growing risk appetite. However, the sticky inflation picture means that for some central bank rates could remain elevated longer than markets hope. Borrowers should take advantage of stabilizing conditions while keeping an eye on wage pressures and geopolitical risks. Now, turning to President Trump. Let's highlight what we have seen out of the new president that could impact Europe. On Monday, Donald Trump entered the White House as the 47th U.S. president. Prior to his inauguration, there was plenty of bluster about what he would do once in office. Some of this was discounted as just that, bluster. But on Monday, with a slew of executive orders, he proved that a lot of it wasn't, and he intends on following through with a number of his threats. In terms of Europe, there was not a lot of direct impact out of those orders, but he did highlight his intention to tear up the world order. His withdrawal from the World Health Organization and removal of the Pillar 2 tax plans demonstrates President Trump's intention to focus on U.S.-first priorities. He signaled that Mexico and Canada would be first on his tariff approach, with plans to be in place by the end of the month. While Europe has not directly been mentioned as of yet, or at least as of our recording, we would anticipate that he will shortly announce his intentions in this regard. At the moment, all of his policies are pro-growth for the U.S., at least in the short term. But for me, the big impact of these executive orders is a big warning to Europe and where I think there will be focus in 2025. Deregulation, or at least a change in regulation. The biggest theme of his executive orders was to retract regulations implemented by the Biden administration and to explore rolling back more than just those regulations with the implementation of his Department of Government Efficiency. This puts Europe on the back foot in order to remain competitive on the global stage and to ensure that the region can target growth. The PRA in the UK on the 17th of January kicked this off with an announcement to suspend the implementation of Basel 3.1 for yet another year to January 2027. This brings us to Davos, where this week people like Ursula von der Leyen, Rachel Reeves, and the likes of Scholz and Merz out of Germany all target an audience with top business executives, focusing on support for the region with pro-growth strategies. For example, von der Leyen has already stated that they will look to reduce national barriers within the single market and target opportunities with countries like India and China. This is where Europe can look to capitalize on the Trump era, picking up on making deals with regions marginalized by President Trump. An IMF blog recently emphasized the need for structural reforms to address growth challenges, stating, "Unlocking growth in Europe requires a combination of targeted investments and regulatory streamlining to reduce inefficiencies." This aligns with European Commission President Ursula von der Leyen's address at Davos, where she underscored the importance of strategic autonomy. She hinted at loosening regulations on green energy projects and fintech to help spur innovation and attract foreign capital. It also matches with the Draghi report, the Neuer report, and many other commentators that we have heard from in the past several months. However, Europe now needs to act. Bernard Looney, the CEO of BP, previously remarked, "For Europe to lead in the energy transition, it must cut red tape and accelerate project approvals." However, critics remain concerned about the potential weakening of consumer and environmental protections. For credit investors, these developments could mean opportunities in industries like renewables and technology, but political risks do remain significant. This evolving story in Brussels warrants close attention. The intersection of artificial intelligence, slowing growth in Europe, and unemployment trends is another focal point of recent discussion. AI promises to revolutionize industries, but its impact on labor markets is a double-edged sword. At Davos, the role of AI in shaping future employment is a dominant theme. In Europe, where growth is slowing due to weak industrial output and lingering energy concerns, AI adoption could exacerbate unemployment in traditional sectors, like manufacturing and customer service. However, a recent survey of global CEOs by PwC stated that more CEOs, about 17%, felt that AI had increased headcount, versus 13% that said it had decreased headcount. AI-driven industries such as robotics and software development are poised for growth. Governments and businesses will need to implement proactive labor policies, including reskilling programs and investments in education to help manage the transition. For us, while this is the overarching long-term trend, the risk of rising unemployment in the short term could elevate consumer defaults, with companies like Volkswagen and BP making large-scale job cuts, as well as many UK retailers suggesting the same. There is a risk of rising unemployment in the short term in some sectors, alongside the growth in jobs to capitalize on the AI trend. Many workers will struggle to retrain fast enough. The key challenge is navigating the uneven distribution of winners and losers in this transformation. Finally, let's address trade policy, a topic revived by President Donald Trump's proposed tariffs on imports from Mexico, Canada, China, and other trading partners. This discussion has resonated at Davos, with global CEOs emphasizing its far-reaching implications. Business dislikes uncertainty, and tariffs create uncertainty, and they discourage investment. However, some offsetting factors are in play to help mitigate the impact to some degree. A stronger US dollar in recent months could mitigate the tariffs' impact, as European and UK goods with tariffs may not cost much more to American consumers. As a result, this will limit the impact on demand and help the European perspective in terms of exporters. Still, the potential for retaliatory tariffs looms large, which could hurt sectors like manufacturing and agriculture in particular. For fixed income investors, tariffs could suppress global trade and growth, putting downward pressure on yields. Yet, if tariffs stoke inflationary pressures, central banks may then hold rates higher for longer. The interplay between tariffs and currency movements will be a dynamic space to watch. As we've explored today, the European economic landscape is marked by a delicate balancing act. Inflation is under control, but risks are lingering. Potential deregulation in Europe that could unlock growth, but will spark plenty of debate. AI reshaping labor markets and tariffs re-entering the conversation with all their complexities. Davos has highlighted these challenges and opportunities, underscoring the importance of bold yet balanced leadership. Thank you for joining us on the Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And And if you have questions or topics you'd like us to cover in the future episode, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.